Ford is on a wild ride in 2025. Its stock has surged an impressive 40% since the start of the year. But behind that headline number lies a story of fierce challenges, strategic pivots, and a big question mark from Wall Street. So what's really going on with the Blue Oval? Is this rally built to last, or is it running out of gas? In this video, we'll break down Ford's latest earnings, its major strategic shifts, and what the analysts are really saying. Let's dive in. Ford Motor Company is a global automotive and mobility giant headquartered in Dearborn, Michigan, renowned for designing, manufacturing, marketing, and servicing a full line of Ford cars, trucks, SUVs, and electrified vehicles, alongside the iconic Lincoln luxury vehicles. Founded by Henry Ford in 1903, the company revolutionized industrial manufacturing with the introduction of the moving assembly line, making automobiles accessible to the masses and shaping the modern automotive industry. As one of the world's largest automakers, Ford maintains a strong presence on key continents and is actively steering its legacy brand towards the future through significant strategic investments in electrification, with models like the Mustang Mach-E and F-150 Lightning, as well as developing connected vehicle services and autonomous driving technologies. First, let's talk about the good news that's been fueling the stock's rise. Ford's third-quarter earnings were a clear beat. The company posted automotive revenue of $47.19 billion, blowing past analyst expectations of $43.08 billion. Adjusted earnings per share came in at 45 cents, also comfortably above the 36 cents estimate. This strength shows that Ford's core business is still robust, driven by strong sales of its traditional trucks and SUVs, and it's this performance that has given investors a lot of confidence this year. But here's the flip side, and it's a big one. Despite the strong quarter, Ford was forced to slash its full-year guidance. So what happened? The culprit is a major fire at a critical supplier, the Novelis aluminum plant. This has hit production of Ford's most profitable vehicles, the F-150 and its large SUVs. The impact is severe. Ford now expects a $1.5 to $2 billion hit to its fourth-quarter earnings and will produce up to 100,000 fewer vehicles. As a result, the company lowered its full-year adjusted EBIT guidance to a range of $6 to $6.5 billion, down from its previous outlook. The adjusted free cash flow forecast was also cut. So while the present looks good, the immediate future is clouded by this major supply chain disruption. Beyond the factory fire, Ford is navigating one of the biggest strategic shifts in the auto industry. The electric vehicle revolution has hit a speed bump. With only about 5% of U.S. buyers expected to choose an EV this year, demand is softer than many predicted. This is reflected in Ford's numbers. Its EV division lost $1.4 billion last quarter, its biggest loss since 2023. In response, CEO Jim Farley is intensifying Ford's focus on hybrid vehicles, which are seeing much stronger consumer interest. The company is shifting investment toward longer range and more affordable hybrid models. But don't count its EV ambitions out just yet. Ford is also working on a game-changing $30,000 electric truck for 2027, built on a new, cheaper-to-produce universal EV platform. The goal is clear: survive the current EV winter and be ready with a profitable, compelling product when the market matures. The competitive landscape is stark. Tesla, with its astronomical $1.4 trillion valuation, dominates the EV market share, commanding nearly half of all U.S. EV sales. But critically, its sky-high P/E ratio of over 228 shows the market is pricing in massive future growth from its AI and self-driving bets, not its current car business. General Motors, with a larger market cap than Ford, has more than double Ford's EV market share and a much stronger earnings per share. GM's focus on its Ultium battery platform is giving it serious momentum. And then there's Ford. It holds its own in the broader U.S. auto market, but with just 6.6% of the EV pie, it's lagging behind. Its strength right now isn't in pure EVs, but in a pragmatic bet on hybrids and its Blue Cruise driver assistance system. While this hybrid strategy is paying off in the short term, the question is whether it can close the gap in the all-electric future. One of the biggest attractions for Ford investors is its fat dividend, currently yielding about 5.4%. That's a powerful income stream in any portfolio. But here's the red flag. It may be unsustainable. So far in 2024, Ford has only earned about 11 cents per share, but has paid out 75 cents per share in dividends. You don't need to be a mathematician to see that disconnect. The company is paying out significantly more in dividends than it's actually earning. This is supported by the cash flow. Ford's free cash flow so far this year is $1.3 billion, but it has paid out $1.8 billion to shareholders. The dividend is being supported by the balance sheet, not by current profits. While this policy helps keep the stock afloat and attracts income investors, any further profit squeeze could force Ford to make a very difficult decision about cutting that payout. Beyond competition and dividends, Ford is navigating a minefield of external risks. Macroeconomic headwinds, high interest rates and inflation are making cars less affordable for everyone, pressuring Ford's core business. Supply chain shocks. The fire at the Novelis aluminum plant is a perfect example. A single event is expected to cost Ford up to $2 billion in profit and will disrupt production into 2026. Trade wars. U.S.-China tariffs are expected to slice another $2 billion from Ford's 2025 profits, straining margins even further. The EV squeeze. Ford is in a vulnerable middle position. It's losing ground to GM's scale and efficiency, while it can't match Tesla's tech and software prowess. With weak overall EV demand and its EV units still losing about $1.4 billion per quarter, the path to profitability is steep and uncertain.
So, where do the pros stand? The consensus on Ford is crystal clear, and it's a hold. Let's look at the numbers. Out of 17 recent analyst ratings, only 2 are saying buy. An overwhelming majority, 13, are recommending hold, and 2 are outright saying sell. What does this hold rating really mean? In simple terms, most analysts believe you should maintain your current position. If you own Ford, don't rush to sell. But if you're looking to buy, there might be better opportunities out there right now. It's a wait-and-see approach. Where do analysts think the stock price is going? The average price target sits between $11.25 and $11.35 per share. Now, here's the crucial part. With Ford trading recently around $13.80, that price target implies a potential downside of 15 to 18%. That's a significant caution flag. And it's worth noting that several major firms like RBC Capital, Jefferies, UBS, and Barclays have recently raised their price targets. But critically, they mostly kept their neutral or equal weight ratings. So, while the outlook is improving slightly, it's not enough for them to turn bullish just yet. Ford stock is seen as fairly valued to slightly overvalued right now. There are a couple of bullish analysts saying buy, but the overall sentiment from Wall Street is neutral. It's a stock to watch, not one to chase. What's your take on Ford? Are you holding, buying, or selling? Let us know in the comments below. And don't forget to like and subscribe for more straight-talking stock analysis.